if you really have the time, there isn't really a risk. You just need to really do your homework and know what you're doing.
Even there are people who think that like value investing is dead already.
Every time I say, hey, buy this one lah. But what they would reply back to me is that, hey, this one like don't even move.
Are there any other common mistakes that you see investors making for that?
So many mistakes.
So many. Struggling to keep up? Welcome to the FOMO Fix. Welcome back to the FOMO Fix. I'm Hazelle from The Joyful Investors, your navigator on this journey to financial empowerment. Growth stocks or value stocks? Now this got to be one of the hottest debate in the investing world, and in this episode, we're going to explore which might be the real winner for your portfolio and also uncover the potential of small cap stocks. Joining me today, I've got two awesome guests, James and Choon Kai. Say hi to the audience.
Hello everyone, I'm James. I'm an SGX Academy speaker, right? And I also own a small cap focused blog called SmallCapAsia.com. And at the same time, I do also look at US stocks and do some of the videos in my YouTube channel called Invest Kaki.
And I'm Choon Kai, so I've been doing wealth management for like a year. But actually my investing journey started about 2 to 3 years ago. Have been dabbling with stocks here and there. And I personally even did try day trading before.
Okay. Sounds
cool.
interesting. Okay, let's now first kickstart with the basics first, right? So maybe James, you can share with us, how do we define a growth stock versus a value stock?
Growth stock, when you think about it, people will talk about, US growth stocks like Tesla, like
Yes.
Nvidia. They are growing their revenue, their profits by double digits, triple digits, that kind of magnitude. And that would what generally people classify as growth stocks.
Okay.
Value stock, on the other hand, we talk about valuations. So like we focus more on how undervalued it is based on different metrics. PE ratio is definitely one of them. We also have other things like price to sales, price to book, price to free cash flow, or even intrinsic value, which you use the model to calculate the actual intrinsic value of a particular stock.
The discounted cash flow model.
So I know of a lot of friends, right, who invested in growth stocks. Like for example, we talk about Tesla, right? They don't really look at the valuation per se. They focus more on the growth story. So, how can it grow their EV fleet or things like that?
The growth potential.
The growth potential. So although their valuation, or rather like, things like PE ratio is rather high, they think that the growth can more than compensate for this kind of high valuation. So as a result, there are usually these two camps, growth versus value.
Why do you think that these two different types of stocks tend to attract different types of investors?
It's very easy. Like from my point of view as well. So like if you are young, like Choon Kai, you have the time is on your side. Like you have a very long time horizon, like 10, 20 or even 30 years to wait for the growth to happen. For me, I look at value in the sense that I like to be more certain. I can see that, this stock, I feel that the value is maybe $10 and right now it's trading at $5. So there's a margin of safety over there for me to wait for it to realize the gap over there. So it's more of actually boils down to one person's personality, I would say. Whether you want to be on the safer side or you're more gung-ho and you can look for growth, right? And for a long period of time.
But these days there's a lot of people who really like to do growth investing, right? Because they think about the potential gains that they might get on this, right? What's your investing style, Choon Kai?
I'm more growth focused.
You're more growth focused,
He said to me, value stocks is more like the big, blue chip ones. So like, in my opinion, I will put more like Google, Amazon, all these more into value because they still have long-term growth potential. They are sustainable. So it's just consistent returns. But then, as he said, I have the time frame, so more gung-ho. And my risk appetite is very high. For me, I'm more into growth because I like to take the risk, and I feel that if there's potential, and for me, it's the vision. The vision of a company is very important. My own portfolio previously was I even had Palantir also. It's quite a well-known growth stock. But for me, when I trade stocks, it's more like trading. So I have a take profit target to take and go.
So you do more trading as opposed to really like long-term investing?
My long-term investing would be a different kind of like style, more into like funds, so that I don't have to manage it, even like really manage the portfolio.
Okay, so like ETFs, for instance.
ETFs also, yes.
Okay, so you have two separate portfolios. One for your trading, then you will trade the growth stocks then, and the one is for the long-term investment.
Really long-term investing.
Yeah, then you invest in funds like ETFs. Okay, I see. Yeah, so in recent times, in fact, not just recent years, I think the last 1 decade, right, growth investing has been really a hot favorite. Yeah, and because of its outperformance, where it has been doing really well, the growth stocks, and that is why. But myself, I also believe that at some point in time, this divergence in performance, it may stop widening, and there may be some reversion to the mean. So growth stocks, they can also see greater pullback. And when that happens, the funds might flow into the value stocks as well, right? Yeah. So, but even when that happens, neither would we say growth investing is dead, isn't it?
Yeah, correct.
Yeah. So I believe that it's a matter of perspective as well.
Yeah.
Because right now we are all in this decade where we have experienced the outperformance of growth, but that if you look at other generations of investors, they have also been through periods where value has been doing well, or after which then growth does well, then value and so on. So actually, to be fair, every strategy they have their periods of outperformance and also underperformance, right? Okay, so we talk about growth versus value. Let us now shift our focus to small cap stocks. So Choon Kai, you mentioned that you prefer growth investing. So what's your take on small cap? Do you invest in small cap?
Small cap.
Or do you trade small cap?
I don't really trade small cap because as your portfolio grows, you want to start taking lesser risks to preserve the capital and still grow. So, but in my opinion, when I was starting small, then small cap was what really grows my portfolio. So it's something I was using for a short term to really grow it fast. At the start, to try to grow the portfolio fast before you start diversifying. And obviously, as you start investing more, you learn more. Then you learn how to actually diversify than to really just gung-ho all in one. Even though I still like the focus method, because when you're more focused into just maybe 1 or 2 stocks,
more concentrated.
it will grow your portfolio faster. So yeah, it's more concentrated.
So right now, you don't actually do small cap lah.
It was last time.
But are there any reasons like why you no longer want to put any part of your money into small caps?
Maybe as you have more money, you will start taking lesser risks. I think it's just
lesser risks. Yeah. Okay.
But just now you mentioned when you invested in small cap stocks, you make a lot of profits, right? You make a lot of gains. Then why don't you continue?
I learned that the hard way from day trading. So when you trade, you lose money fast. So that's only when I really understand the purpose of risk management. So if I continue to take such risks, it means I'm going to wipe out my portfolio again. And then if the money doesn't come easy, you don't want to lose that money fast. Yeah, so I started knowing not to really gung-ho and go all in everything. Some things you have to, maybe 50-50 is also another take you can take. So that you have like the saying is, as long as you still have the capital, you can go off another day. But if you finish everything, then there is no tomorrow. Yeah.
I believe you raised up a point where it will resonate with some retail investors. So there are some retail investors, maybe they also have concerns about small cap. So maybe let's try and do this in a more balanced discussion. Let's talk about both sides, the advantage and also the risk of investing in small cap. Maybe we start on the positive side first. So advantages, James, could you share with us what kind of advantages can investors get out from investing in small cap?
Okay, so one of the big advantage, like what he shared, right, is of course the big potential gains lah. Like for example, if you want to compare maybe one small cap stock like Marco Polo Marine, which is a shipyard business,
industry,
and versus another blue chip stock like Singtel.
So
a 10% jump for a particular small cap stock is not a very big hoo-ha as compared to Singtel jump 10%. Every investor, like even my dad will be like, hey, Singtel jumped 10%. What's going on? That kind of thing, like. But it's very common for small cap stocks. Small cap stocks are generally neglected. And that's the reason why I like them actually. So because small cap stocks are usually, people don't really do the research on them. Generally, there are not a lot of analysts covering them. Even if there are only a few, like 1 or 2. Most of the big money, most of the funds, their mandate is to invest in big companies or blue chip stocks or even REITs or ETFs. But, they have a you think about it, professional fund managers, they have like hundreds of millions or billions of dollars sitting inside. If they were to just whack 10% into a small stock, they will be able to buy it outright. So it doesn't make sense for them to focus on this space. And that's why, actually, for me, I realized this from the very beginning.
It's a hidden gem for you.
Yeah, so I've always been focusing on small cap stocks.
Oh, okay.
I would say that I have strong track record over here.
For small cap stocks.
Yeah. Or maybe I just share another stock.
Okay.
Which is what I'm invested in right now, is SimLeisure.
Okay.
It is the one that manages Kidzania, Singapore. They just opened this year. I haven't even been there with my kids. But I already saw around 2,000 plus reviews, positive reviews on Google reviews.
Okay, I see.
So I invested back then, I think 2 years ago. They were managing escape theme parks in Malaysia. So I realized this gem. I've always talked about it during my seminars, during my, to those who really caught on, then good for them lah. As in they can ride on with me. But generally, I feel that back then there wasn't a lot of coverage on SimLeisure, and that's where I really deep dive, and then I see that okay, their business is doing well, the profits are there, as in you are getting money directly from the tickets, right? It's a very kind of stable business model, I would say, unless there's another COVID happening lah.
So we talk about the positive part. Let us now also look at the potential risks. Just like Choon Kai mentioned risks, right? So what are some of the risks of investing in small cap stocks?
One definite downside is the volatility and also the lack of trading volume. Every time I say, hey, buy this one lah. I don't really tell them to buy this one. I say, you can check out this stock. I'm invested in it myself. But what they would reply back to me is that, hey, this one don't even move. I say that, yeah, Singapore stocks is like that. No, but then in general sense, right, it doesn't move until there's a catalyst. So what I would really look for is to negate the so-called risks involved, right? That it has low trading volume. I treat it as more like a advantage for me, in the sense that when everyone starts to see their potential, everyone will chong in, rush in, and then push the trading volume up. And then they will, in essence, also push the share price up.
Yeah, and so you're already inside.
Yeah, I'm already inside.
Okay.
So that's the case that happens with a lot of small cap stocks that I bought into. So I do look at a few catalysts. One of it is insider trades. So I look at when either the founder or the CEO or C-suite, they start to buy back their own shares using their own pocket money. Okay, not pocket money, their own money. Yeah, but it may be, a material to them. But in general sense, Peter Lynch also shared, right? You will only buy when you believe in the company's potential. So that is the reason why I look a lot at insider trades. And then when they are actively buying back, and that's what happened to IFAS in year 2020. So I took notice, and then I see that, okay, generally it's still doing well, be it COVID or not. And I also, hop on board lah.
Okay. Yeah, so you shared one about the volatility, the liquidity, right? Yeah. So any other risks, Choon Kai, that you have in mind that deter you from investing in small cap stocks at this moment in time?
I think honestly it's also, for me, is at the point now is like the lack of time to continuously do research. But my thinking is that I feel small cap stocks is worth the risk as long as like James here really did the research. If you really do the research, there isn't really risk because you did the homework, you know what you're doing. Even though with the volatility, I mean, as long as you had a target in mind and then you had an exit point, I feel that as long as, even if it drops, you should just hold it on until it hits the target that you desire. By then, you are actually removing the risk out of the game. There is volatility, but you just have to have the time frame for it. So if your time frame is like, you really can't like see your stock drop like 50%, then suddenly increase another 100%. If you can't really, if you're like someone that can monitor the charts of the stock price, then maybe it's not the best to invest. But if you are really someone that just buy and hold, and maybe if your dollar cost average in also can, right? So dollar cost average into the small cap stocks for maybe a year, but you had maybe a share price that you will stop buying at, that you just hold until the share price to exit. Because that's what I did last time. So that's when I know that if you really have the time, there isn't really a risk. You just need to really do your homework and know what you're doing.
So as you're speaking, right, I thought about one. What about this is one of the common concerns from retail investors is some of them think that small cap stocks in terms of fundamentals, they may be weaker as compared to the large cap stocks. So during times like recession or high, like for instance, we were experiencing the high interest rate environment, right? So small cap stocks in terms of the financing, would they be more impacted as compared to large cap stocks? Do you think so?
I think generally yes. Maybe I just quote another example. Like RENS.
Okay.
So that one is owning Ichiban Sushi. So I mean across F&B sector in Singapore, we have a lot of listed stocks lah. Like Japan Food is Ajisan, RENS is Ichiban. You know, generally they all face one issue, which is rising costs. Rising operational costs, be it from the labor point of view or, you know, just the ingredient costs also going up. So if I were to compare it with another bigger company, maybe they will have like economies of scale to sort of, you know, tell the suppliers that, hey, don't charge me.
Costs, right?
Don't charge me so high. That kind of thing. Like, or even like Sheng-Siong, right? Sheng-Siong,
Yeah.
they have the bargaining power because they have so many stores as compared to, you know, if some other
smaller
mom and pop store, right? You treat it as a small cap stock. The mom and pop would just have to take whatever that's given to them. Yeah, so I think
so that's a potential risk lah.
Yeah, right? Another potential risk.
Right. So we talk about both sides, really, the advantage as well as the risk, right? So at the end of the day, how can small cap stocks play a role in a diversified portfolio? Is it depending on the investor risk appetite? Then you see how you want to allocate your funds to small cap.
Generally, I think also boils down to the risk appetite of the individual investor. So, for example, myself, I am 50-50. 50% in small cap stocks, 50% in US stocks. So I'm like the both extreme ends of the spectrum. One is I look at very deep value small cap stocks. The other one I look at high growth US stocks. But for my dad, right? I mean, he's also like an avid investor. He has 90% in REITs, 10% he keep it for small cap stocks. Generally, I advise him hey, which one is good, which one is you can avoid, and things like that. So he treat it as tikam money. So he take this 10%, then my son give me some good stocks, and then he will just try his luck, that kind of thing. But generally, he gets most of the passive income from the REITs lah.
Yeah. So I get your point. So it really depends on the investor profile. Like, so for example, for Choon Kai, maybe he thinks that it is more risky, so he at this moment in time he stay away from it because he also doesn't have the time to do the research, right? But for people who are interested, who are okay to take up a little bit more risk, they can actually put in some money to small cap. Then, of course, on the other end of the spectrum is those who really want to, they are really all right with the risk, the potential risk of small caps, right? And they want to capitalize on the advantage. So they could even be just doing 100% on small caps, right? So at the end of the day, it depends on your risk profile and, of course, the strategies that you have to manage whichever portfolio mix that you have. Yeah, because we have also heard about stories. While we have heard a lot of stories about how people profited from all the blue chips companies, we have also heard of really real stories of people who have invested in small cap. They have done well, they are semi-retired and so on, right? So both are actually workable, but it depends on your profile and your strategy, right? Okay, So now we talk about growth, value, and small cap individually. Let us now bring all of them together, right? And what's the relationship? Can a small cap be a growth? Can a small cap be a value stock as well? Can it be so?
Yeah, I do think so. In the sense that for a few of my small cap stocks that I own personally, they are so-called undervalued, which is a value stock, and they do have growth potential. Like the one I covered, Sim Leisure or Marco Polo Marine or some other stocks lah. So they do have both qualities in them.
Are there any like particular sectors or industries where this may be more prominent, like where you will see small cap growth or small cap value being more prominent? Any industries or?
I think for small cap growth would be a lot in technology.
Small cap growth, a lot in technology, okay.
Because nowadays there's a lot with the booming AI industry. There's a lot of companies going pop up here and there. Obviously, then we have to do the research as their business model sustainable, or is there like a vision they're going towards too. So technology is definitely a sector, and I mean mainly growth stocks really also mainly consists of sector for technology now. And it's a very, very hot topic.
Tech is definitely one sector,
yes.
But from me investing in so many small cap stocks, I feel that the sectors that are neglected will tend to do well. So like for example, that time oil prices went even negative, right? So you can, if you were to go into the offshore marine sector back then, you would have made like more than 100%, 200%.
As a small cap value.
Small cap value.
Okay.
Yeah, so it also depends on which sectors you think will turn around. Like for example, right now I think the very hot one is offshore marine, because they are also shifting into cleaner energy vessels and things like that. So cleaner energy is one sector, and then building and construction.
Building and construction.
Yeah.
Okay.
So back then, COVID, a lot of the companies, right, their projects have a lot of cost overruns. You know, when you go to the government and you take on a certain project, you say that, okay, my cost is 100. So I will bill the government, let's say 110. I get a 10% profit margin. But then, after which, you know, when COVID happened, a lot of the costs balloon, right? They are looking at costs of like maybe 150 versus what they are getting is 110. So they are actually losing money. So if you were to look at a lot of their annual reports or financial statements, all of them have lost money in 2021, 2022. And then from there, 2023, they start to rebound. They start to get projects of higher margins. They know that, I don't want to go into things that I'm not sure of and things like that. So they don't want to expand too aggressively and things like that. They want to be more secure. And I do see that this is a potential turnaround. Right now, it's still going on. You see from ISO team, which I also vested in, it's only trading at 6 cents now. I think 30-something cents, all the way to
6 cents now.
3 cents.
Oh, okay.
Yeah, or 4 cents. I think I went in around 4 cents. So right now it's 6 cents.
Okay.
Yeah, something like that.
Okay.
So yeah, but you have to do a lot of research, both on the industry and in the company.
Company itself.
You have to look for maybe the management interviews and that kind of thing. You see that we are very confident in the next 12 months, that kind of thing. So these are the things that I look at.
Okay.
Where, you know, when you compare small cap stocks versus other maybe blue chip stocks or even US stocks, right? You cannot get this kind of vibe that is intangible asset.
Okay.
Yeah. That's
my take. I see.
Yeah.
Right. Okay. So right now, as we speak, right, the US Fed has already embarked on the 50 basis point rate cut. And moving forward in the next 1-2 years, right, it is anticipated that there will still be further rate cuts. So a lot of people are talking about maybe there might be a recession, right? Less about the inflation right now. So as we can see from all this, right, there's always a change in the economic conditions. So there will be shifts in the economy. So Choon Kai, for yourself, right, do you actually adjust your investment strategy to respond to these shifts in the economy? Or how do you typically balance your portfolio in a typical market cycle?
Honestly, I do adjust based on the market cycle, based on the economy. In the US, there is secondary market for like bonds. So in Singapore, we can only probably pass it back to the government, get back the money. So to maybe simplify, it's like now I bought this SSB at $90 for probably 7%. Now for that same SSB, it's still $90, but it's only giving out 5%. I can probably sell it for $120 maybe.
Okay.
So hence I decided to hedge this opportunity. I put about 80 to 90% of my funds into bond funds, because secondly, bond funds are still safe. And now it's for potential return, probably as good as a growth stock. That's why I decided to readjust my portfolio based on the market conditions. And I did it just 1 week before the rate cut.
Oh, 1 week before the rate cut.
Yeah, so I was 10 ahead. But if it doesn't really go as planned, I still can get dividends. So the risk is minimized. That's what I mean by risk management.
Okay. So that's how you have actually adjusted your portfolio in response to the changes in the economy.
I may still have some in ETFs and like probably 20 or 30%, but mostly like 60-70% is in the bond funds.
Very interesting.
Yeah. So right now, because with all this anticipated rate cuts, right, there's also the narrative about how the value stocks, the small cap stocks, they can benefit, right, where the flow of funds might shift into these stocks, or they may already have been shifting into the stocks, right, to broaden the stock market rally. So on this, what's your take for this, Chips?
I think definitely bullish on stocks because not to go into such specifics about the bond funds. We talk about general market per se.
Okay.
So you think that Singapore, Singaporeans, there are a lot of rich people, right? We have so many millionaires. We always put our money into what? Fixed deposits. Those savings accounts and things like that. So generally when the interest rate starts to come down, like SSB or fixed deposits, like the UOB can just cut your interest rate the next day, next month. Naturally, there will be people who say that, okay, now it's time to look for better returns, right? So where is the other asset class that they are familiar with is definitely stocks. Yeah, unless you have something in between, maybe unit trust. I mean, bond funds is also another asset class. But my general sensing is that people will tend to, look for stocks, say, hey, which REIT is good, which stock, blue chip stock that I can go into. So generally, people go, they invest based on the different asset classes, based on their risk appetite. So like, for example, a lot of people that I know, even my wife, right, they will put into a lot of fixed deposits. Then slowly, as their returns starts to come down, then they will go for higher and higher risk appetite to get more returns. So definitely this flow of funds will be beneficial for stocks.
For the stock markets.
Yeah, you can see it from the China one also.
Oh, recently the China stocks
China stimulus, right? China government just step in and say, okay, I do all these measures, and all the funds, all the even the money managers from US who always say that, China cannot invest and things like that. So they also come into China. You can see from the news. Yeah, so everyone is rushing into China, and that's why their stocks all went up like double digits.
Yes, in the last 1 week
crazy.
or so. Yes. Right. Yeah. So I believe that stock market likely they will also continue to be beneficiary in this sense, where people start to find another instrument that can give them higher returns, right, other than fixed your T-bills, right, and so on.
Yeah, correct.
Yeah. So at the end of the day, fundamentals will be important, right, when you're choosing on all this, because for those stocks that are still beaten down back then, right, they haven't recovered. So what a lot of people would think is, it's very risky because there is a market crash or there's a crash for those stocks, so they will stay away from it. Yeah, but if you can adopt a more opportunistic mindset, then you can actually scout for all these beaten down good stocks, high quality companies to actually accumulate. And eventually when all this happens, right, when the flow of funds starts to shift, then you will be able to ride the rally up in this recovery. Yeah, so that's for the market trend. So when we are looking at, for investors, beginner investors who are looking at how I can get started on this journey to invest in growth or value or small cap stocks, right? The first question that they will be thinking is, how can I go about selecting them, right? So the selection process, how is this selection process like for you, Choon Kai? What's the thought process when you pick your growth stocks to invest in?
I think when I started, it's less on the financials. It's more of like, I think a lot of noise, especially when I started, was like a few years back. You don't have a lot of experience, so you just listen to a lot of noise, see what's the hype about.
See what's on the forum and all that.
So eventually then you will start, as PE ratio is definitely one of them you will look into.
Okay.
Then you will look into maybe things like cash on hand, how much debts they had. And obviously sometimes also vision, to really look into what the company does. Then you will know what to really invest. So I think when I started investing, it was a good era, also a good time, because it's COVID, everything is honestly cheap. So it's like a black market discount, If it's heavily discounted, you will want to go in. So I bought, mainly my portfolio was honestly in Palantir. That time it was around $7-8. I continuously buy in until like 11-12. But my research was that I know that what Palantir was trying to achieve as a tech company was that trying to look into the problems. So into like tiny minuscule problems that we couldn't see with our naked eye. So that's what their AI did. And then these soft problems actually can turn out to be big problems. And the other factor I considered that what I decided to take the risk, obviously firstly my capital wasn't big. So for one, was there to risk. The guy already. Then the second thing is that actually about 50-60% of their revenue all comes from like military. So I mean, knowing that the US military funding is one of the highest it is the highest in the world, then you know that, I mean, there's a lot of money there and it keeps goes to this company. It means that the government kind of backs the company. So that's why I take the risk. And obviously now it booms because of the AI hype also. So, but then I decided to like, for my trading experiences, I learned to, take profit and go. That's why I take profit, stop loss.
Yeah.
Then I decided to take profit and just probably relocate and like to further describe. So now, because it's a bullish market, because another way to describe this now, as the interest rate cuts means loans are cheaper, companies will get more funding, will get more loans. So definitely companies will do well. So we are most likely entering a bullish market. And most of my portfolio right now is in actually another sector of my portfolio is in ETS, but mainly in HST, Hansing Tech. And I actually buy it through the Lion Global one from SGX. Why is because as the Stock Connect expansion, this means that what I foresee is that they are trying to move the market from Shanghai to Hong Kong. This means that this stimulus check is like just the beginning of it. Okay. So there may be most likely more fundings from the government to try to shift this market over. As if there's more fundings, this means that they are trying to make the market do very well. That's why I decided, why not take the risk and even another majority of my portfolio in the HST ETF.
Yeah.
When I was buying in, it was still about, I think the ETF was about 50 cents now. Yeah, but because of the recent news, I think it went up to about like 70 cents. Yeah.
So your portfolio has seen the gains.
Yeah, I've seen the gains. But as we are entering even more of a bullish market, I think there will be more gains.
Okay, so that's your thought process on how you actually build up the portfolio, right? Maybe James can share with us, are there any metrics that you look at to select and screen for the stocks to buy, be it growth value or small cap, or any tools that you also employ yourself?
Yeah, okay. So there are a lot of screeners in the market, but one free tool that I do use is SGX Stock Screener.
Okay.
So there are a lot of metrics over there that we can use. If it's the value camp, I will look at things like market cap, net profit margin, so like turnaround sectors, right? Building, and then maybe the market cap shouldn't be so big. It's like maybe at most 1 billion or even smaller, like because Singapore companies are rather small. So like maybe lesser than 200 million and things like that. So that will serves as a starting point for me to really deep dive into each single company. Yeah. So like also the valuation matrix, like PE, PB. Yeah,
any particular ones that yourself you actually look at more for the valuation metrics?
One of it is definitely sales growth. Revenue is the lifeblood of any company, right?
Yeah.
Any business. When you look at companies that share prices, you want the share prices to go up. Definitely you need their sales to grow up. So sales go up, then everything else will follow suit. Profits, cash flows and things like that. So at least there's a growth story over there. Yeah. The other thing I look at is the free cash flow.
Okay.
I want it to be positive. I mean, I've done a lot of research in other companies, other stocks. Even if they have a positive net profits, it doesn't mean that they have a positive cash flow. And chances are sometimes, there's some accounting irregularity, or they just happen
that can
to
affect the profits and the...
Yeah, so naturally I want them to focus more on the positive cash flow, and from there, right, if you are a company, a business with a lot of positive free cash flow, you're able to reinvest that to other aspects in your business. One thing is mergers and acquisitions. That's how the big companies become bigger and bigger. Right.
Yeah.
The other one is, of course, to give dividends.
Yeah.
If you talk about like McDonald's or 3M, they are the big companies, or even Colgate, right? So they are able to continue churning out free cash flow, and then from there they are able to pay out dividends. even though their dividend yield is quite little as compared to Singapore stocks, but they are able to grow it like across 30, 40 years. Coca-Cola, Warren Buffett invested in Coca-Cola, like it already paid for with the dividends, right? Yeah, so this is why free cash flow is very important. So that is the second metric that I look at. The third metric that I look at is debt.
Okay.
So whether they have a lot of borrowings. Case in point, we have Hyflux in Singapore, right? So Hyflux is one good example that you shouldn't borrow too much to expand your operations.
More than you can manage.
More than you can manage, yes. Another example is the US banks. Silvergate Bank, if I'm not wrong.
Okay.
When things bad happens, it tends to fall off very quickly. It tends to spiral down very quickly. So one example for Hyflux is that when they realize that they are not having free cash flow, so it's a negative free cash flow. So even though on paper, right, back then I did my research on Hyflux, they were showing positive profits, but when you look at the cash flow, it's actually
a different story.
It's like opposite spectrum. It's very negative, and then they are using debt to pay dividends because they have a lot of perpetuals also. So they are using the borrowings to pay off the dividends, which is a real big flag for me already. So back then, my dad also asked me, hey, is it good to invest in Hyflux? Temasek company. But back then, Temasek already pulled out. That is what a lot of people don't know. So if you want, you can go SGX, check out for every stock, there's this top 5 or top number of shareholders. You can actually check who is owning that particular company. Yeah, so from there, I already know that Temasek is already out of the picture. So the Hyflux is there by itself. The operations, cost overrun, negative free cash flow, too much debt. I sort of know that something is going to happen. And that's the very big reason why I think if all other things you don't look at so many metrics out there, right? One of the metrics that can really gauge whether this company is growing by either their own operations, core operations, or growing by the debt, you have to look at the debt to equity ratio.
Yeah. Okay, so these are the three metrics.
Three metrics. These are the more quantitative side. So I have the more qualitative side. So I also do look at things like the management team.
Okay.
I want the management team to be experienced. I think one very good example is Nike. So if you are following the news, right, the old CEO who has just been, kicked out of the company, he came from the tech sector. As in, he has a lot of expertise in the tech region, but he's not familiar with fashion per se. So for Nike, if you think about it, shoes are almost the same when it comes to the structure. Why would some people pay more for Nike shoes as opposed to maybe other brands, China brands? It's the branding. So the brand itself is very important. And you have to have some retail or fashion experience person to come in and
to lead the company.
To lead the company, correct. So like if you were to ask me to go, I don't know nuts about fashion. I'm always those who, like for example, I always ask my wife, this outfit nice or not? Like for example, today, the outfit that I wear, I also asked my wife yesterday, what can I wear today? So she picked this for me. So I just follow her orders and then just come here. Management team is very important because they are the one that drive the company forward. They are the real. If you look at a lot of the blue chip stocks in US, the FANG stocks, Mark Zuckerberg, Jeff Bezos,
they have the expertise and the foresight.
Yeah, they have the expertise and the foresight. So it's more of owner-operated companies. Like I would phrase down to these owner-operated companies.
I see.
And the last thing, more for US stocks, so less for small cap stocks, is economic moat. How you protect your
moat,
your earnings from competitors is always about
it's
the
very
moat.
important, right?
Yeah, like for Coca-Cola, it's always about spreading joy, happiness. So the brand is already there. Warren Buffett also said before, right? Even if you were to give me 100 billion or 1 billion, I wouldn't even be able to topple off Coca-Cola. So that's how strong the moat they have.
I'd like to buy the world a Coke and keep it company. Of course, I could buy the world a Coke, but I'm not sure my shareholders would go for that.
I think there was one development I was pretty excited about is where the KFC, so
KFC,
Yum
under
brands, they partner with Coca-Cola instead of Pepsi. I think
okay.
that was 2 years ago. All this boils down to the moat. If you have the moat, then you can continue to sustain your earnings for a long time to come.
That's where they have the competitive advantage. So when you talk about all these strategies, right, there is one very commonly adopted strategy by many retail investors, which I think actually Choon Kai, you mentioned a little bit earlier on, which is the buy and hold investing strategy. So buy and hold, Choon Kai, is something that you use yourself, right?
For me, I have a belief in buying and holding. It's because at the end of the day, the purpose is very clear. It's mainly for retirement. Maybe inflation rate is 5%, then our returns are 5%. So that our investment returns actually cancel out the inflation rate. To sum it up is that we are indirectly just saving $1,000 so that when we retire, that $1,000 is still worth $1,000. So I'm very firm that we have to set some cash aside for our retirement. So investing is always for long term. That's why I have more of a trading and investing portfolio. Because I know that my investments is really for the horizon for 20, 30 years. So whatever adjustment it's for, that end goal was only for retirement.
So your ETF, which is for your investment, right? So you will do the buy and hold.
Right. Mainly for buy and hold,
But of course, trading, then there's no buy and hold, right? Trading, you have to set your stop losses, your take profit target and all that.
Unless it's really blue chip, they are more sustainable. I think that it's best to still minimize your risk and take profit. This is my point of view. This is how I would do. But I would probably have take profits targets for like different stocks so that I can take and go and probably find the next opportunity.
How about James? So for you talked a lot about small cap earlier on, right? So small cap, do you think buy and hold is a good strategy, or do you think trading small caps
makes more sense?
What do you think? Because I think that's something that people also debate about.
Yeah. So when it comes to small cap stocks, I do have a time horizon that I look at around 1 to 3 years. If you would say that that's not, to some people is trading because you're not holding 10 years or more, you're not looking at the long term, right? But for other people, they'll be like, hey, 1 to 3 years is too long. I want to
not consider trading.
I want to trade like up down, look at the technical charts and trade. Why 1 to 3 years is also based on my past experience.
Okay,
so whenever I invest in small cap stocks, I do look at the catalyst. So first step, I look at whether there's value. Second thing I look at is whether there are catalysts. A few catalysts that I look at. One is I mentioned before, the insider trades, so insider buying. The other one is increased media coverage, which only happens when the management is so-called bullish about their operations, and then they will start to, hey, help me cover this, help me cover that. The third thing is, of course, their results. Their results have to back up whatever there is to be shown in the market.
Yeah,
so
definitely.
Only when you have the results, then more analysts will come in and cover them. More analysts start to cover them, then
more trading activity.
More trading will come in. More, start off with maybe the traders, and then once the traders boost up the trading volume, then maybe money managers who are smaller in size will come in, and the retail investors will also come in. Like, they say, this one already go up like 20-30%. Maybe it's time to take a look, and that kind of thing. So it's if you think about it, it's a positive spiral for small cap stocks. And for me, myself, I like to look at it when it's right at the bottom. So that's how I gauge myself, like 1 to 3 years. So for all the stories, the growth story, or rather the, for them to turn around and that kind of thing, right? Their story to pan out, I need a 1 to 3 years time frame.
Yeah. So because you mentioned this 1 to 3 years, right? So I'm curious. So if let's say after 3 years have passed and the stock didn't actually do as well, then what would be your mixed action?
Just cut loss.
Cut loss
Yeah.
and move
I have
on to
also
another.
a very high risk appetite like him. I generally, even if stocks fall 20-30%, as long as I feel that there's no story here, I mean, it doesn't fulfill my criteria, I will
then
cut
you'll
it.
move on to the another stock idea.
Because if I think of it from another perspective. If let's say I put in 10,000 into this particular stock, I lose 3,000. I'm left with 7,000. But if I can reinvest this 7,000 into another stock that can move up 50%, I can make back that 3,500.
Okay.
What if the stock drops like maybe 70-80%? It's a drastic one. But you still feel that there's a vision. Would you hold it, or will you think that there's a better buying opportunity? It's best to reallocate so that maybe this 3,000 actually can move to maybe this small cap stock has a really huge, another small cap stock that has a very huge growth potential. Will you reallocate, or will you hold on to the stock?
He like,
I'm
it's
just
thinking
curious.
deeply.
I'm just curious,
very
like,
deeply.
to see what will you do in such a scenario.
Okay,
like,
I have one very good example for my
Okay.
own stock, right? It's a US stock called Curiosity Stream.
Okay.
Okay, so it is like a Netflix alternative, but it's focused on documentaries. And back then, during the COVID period, I was thinking a lot of people will float to all these streaming companies. So instead of buying Netflix, which is a big mistake, I know, I went to look for some other smaller companies. Yeah, 屁股痒, like. And then I saw this Curiosity Stream.
Yes.
It's still listed, but it's now trading at $1. I bought it, I think $10. Yeah, $10. It was if I'm not wrong, it's a spec company.
Okay.
So it listed
okay,
$10.
okay.
I lost 80-90%. But I'm very proud to say that I've already cut loss. Yeah, that means I say that, okay, the story is not there, I just cut. Yeah, so it really fall from $10 to, when I cut, it was around $1.50. So I lost 85%. Yeah, 85%. Painful, yes, very painful. But it is a part and parcel, I would say, during this kind of investing
This is also
journey.
a learning experience, right?
Yeah. Learning experience.
Okay.
So one very important lesson I got from this particular stock, right, is that I should be familiar with the companies I invest in. So from there on, I'm really very careful. I will only invest in companies that use their products or services.
Oh, okay.
Yes.
So you're really familiar with them.
Yeah, I think Elon Musk gave a very good quote before. Buy stocks that you use their products and services, and sell when you don't use them anymore.
Okay. Okay.
So that is like if you think about it, that can be a trading strategy. That can be also a buy and hold strategy. So like for example, if you were to invest in Google, and then you keep using their products, like me, for
Every day.
example, I use Google Maps, I use Gmail
Yes,
on a
every
daily
day.
basis. I cannot survive without Google. So to me, it's really a buy and hold quality stock.
Okay,
So I would just park it there, lah. And then every time, my usual method is like every time I have some spare cash, or even I get my bonus or things like that, then I'll just, put in some of to these quality stocks, US stocks.
Okay. Yeah, I think that those are good points that we have talked about. Maybe I add on another food for thought, which is so buy and hold definitely is a very commonly used strategy, and it definitely has all its merits, right, that we have talked about. Yeah, and but one thing to also consider is I think the underlying investment type that we are investing in is also important to decide on the type of strategy, whether buy and hold works for you or not. So for example, if we're investing in an ETF that has a long-term uptrend, like say the S&P 500, right? If you invest in the index ETF for S&P 500, then you buy and hold for the next 10 years later. 10 years later, you see likely you'll be profitable because of the uptrend, right? But the same would not go for, say, if you use a buy and hold for a cyclical stock or a cyclical industry, like say energy sector. So energy sector in the US is the XLE ETF, right? So you do that for 10 years, right? You may be profitable, you may be unprofitable, you could just break even. It really depends on what price you bought it 10 years before that. So another layer of consideration will also be look at what's the thing that you're investing in. Because based on the characteristics of the stock, of the industry, then you can see whether buy and hold would be suitable for the investment, or maybe something else might be more suitable lah. So there are many different types of strategies, and all of them, they have their merits in different aspects. So we align our strategy with the investment, right? Then that is where we can unlock greater value lah for our portfolio. Yeah. Okay. So this is a part on strategy. So looking forward on this, James, do you have any trends or any potential challenges, right, that investors can actually look at, be it for growth, value, or small cap stocks moving ahead?
One very big trend is, of course, AI.
Yeah, a lot of people are talking about this.
Yeah, I think there are a lot of ETFs on AI as well. The other one that I think maybe people are missing out on is cybersecurity.
Oh, okay, cybersecurity.
So
okay.
Because when you think about it, like the recent we call it the Microsoft and CrowdStrike incident, lead us to think that cybersecurity is so important. They are already tying up with all these big corporations. Yeah. So, like for example, in some cases whereby there's some bug in CrowdStrike, it will lead to the whole system being down for Microsoft. But apart from this small incident, I would say, okay, it's not really small, but this one-off incident, cybersecurity is still very important because we are always seeing a lot of cyber threats going on, happening. If you look at small companies, I think in Singapore companies, right, I think there are a few that also resulted in, there's somewhat ransomware incidents, right, that has happened. So I think going forward, they will be spending more and more on this kind of protecting their, ecosystem, their digital
Yeah, it's really
footprint.
important. Yeah.
Yeah, so it's very important for cybersecurity. I think, yes, this one is one. Another one that I have done quite a lot of research on is clean energy.
Oh, okay.
Yeah. So although, a lot of countries, right, they have so-called backtrack a bit because they realize that we are consuming more and more power. Even the data centers from the AI are consuming power. They can't really cope with that from the energy from clean energy sector. So it's not enough. And hence they have to backtrack a bit and use coal, use those oil and gas again. But I still feel that maybe furthermore down the road, like maybe 3, 5 years, 10 years, people will still come back to clean energy because it is our world that we are talking about. We still need to protect
save the
earth.
world.
Yeah, save the earth. So that is another long-term trend that I foresee will happen.
So AI, cybersecurity, and
clean energy.
Clean energy. All right. Let's now move into a quick Q&A segment. Right. So this is the time where Choon Kai, if you have any burning questions, let us talk about them now and address them in this discussion. Any questions on this topic that you have right now in your mind?
In my mind, I was curious that you said that your debt probably like 90% was in like REITs, right? So that then is that 10% is in small cap. But have you ever considered small cap as a way to build like a dividend portfolio for him also? Have you ever think, I'm just in my mind, like do you recommend any small cap stocks that actually gives out dividends for your debt to consider as his dividend portfolios? Like hidden gems that we can also learn about.
Yeah, I think that's a good question. So for my dad's small cap portion, right, allocation, it's more for him to play because he already so-called he can retire with that passive income from REITs already. So I rather him play these small cap stocks than go to the casino and play. So primary objective is for him to tikam. Second objective is to get that dividends because he's looking to buy in, trade in and out. So that primary objective is more like trading. Secondary objective, he can get dividend payouts from these small cap stocks. Then it's a bonus Yeah, and some of the small cap stocks I shared with him, it is really dividend paying. ISO team is paying dividends, for example
So it's quite consistent, like the dividend payout as well.
And if you look at another QAF, Gardenia Bread, right? So QAF is also paying 5 cents dividend every year. If you can go for REITs with more than 5%, then naturally he will, skip that one because he's looking more for trading. So that one is more for playing.
Plus maybe some dividends lah.
Yeah.
Yeah.
Bonus dividends.
And if he sell them, then the capital gains lah.
Yeah. So even if he were to not do well on the small cap stocks, he's okay with it in a sense lah.
Maybe you can share with us. Earlier on, I think you talked a little bit about the mistakes, right? Are there any other common mistakes that you see investors making for? Can be either growth, value, or small cap. Any other common ones that?
Many mistakes.
So many. Okay, what is the most prominent one that you can that you think is really important to convey?
I have one very, very important one. No matter how gung-ho you are or how much you want to chong, you still need to manage the risk. So
risk management.
make sure that you have the capital for tomorrow. If not, if you really go all in, then you're more not really investing, you're really gambling already.
Yes.
So you're like entering the casino instead of the stock market.
Yeah.
So this one is a very common mistake, is that risk management. People will just take too much risk and returns only. They didn't did the homework. Yeah. So homework is very important.
Yeah, I agree with that. That's one very common one. Any others that, James, you have?
Yeah, I thought of already. I sieved down all the mistakes I thought of, and personally, I've already made all these mistakes. So I have one that is very important. I would say that this the quote that is very apt for this one is, if you fail to plan, you plan to fail. So in the sense that a lot of people, when they go into investing, they don't plan what objective they are looking to get out of this.
Just blindly going in.
Blindly going in. Like, for example, if people going for some particular stock, like Singtel, they think that, okay, I want to get dividends, but actually, deep down, they're looking for capital gains. So when Singtel is not doing well in terms of share price, when it go down 10-20%,
so they sell off.
Why like that? Cannot I want to sell off. But then I go back to them, I say, do you invest in Singtel for the dividends or for the capital gains in the first place? Yeah, so
your objective wasn't clear right at the start.
Yeah, a lot of us, including myself, when I go in, the time, I still remember when I first started trading stocks, right? Just the top 20 volume, this one moved to 10%. I just buy. I thought that it will go up another 5-10% the next day or the next week. The kind of, gambling mentality, which is wrong. But even then, I still need a lot of time, make a lot of mistakes to finally realize that, okay, what is my goal when it comes to investing? So for some people, when it comes to, like, for example, my dad, I told him, you need to have a very clear strategy or clear plan. If you are investing for passive income, the bulk of your portfolio should be in something like this. Even if REITs go down, in the past 2 years, don't focus on the stable ones. Focus on the quality ones. You're getting still, dividend payouts from them. It's okay. You don't have to worry about the fluctuations in share price.
Because his objective is to get the dividends to cover his living expenses now, during retirement.
Yeah.
So for him, it wouldn't be a case where you want to go and invest in those growth stocks for the capital gains. You have to sell off and all that.
Yeah. So for my perspective is, I want to build my capital as fast as possible. So I'm very clear on that. So I don't really have a lot of REITs, or rather, I have only one or two in my portfolio.
I see.
And even that one or two is for capital gains. It's not for distribution.
Especially in the last 1-2 years, right? If you have bought at a lower price, you can make profit from the recovery. Right?
Yeah, correct.
I think you mentioned at one point about, just now you say, they move up by 10%. You think that after that they will move another 10%. I think that is a very valid one as well. So one very common mistake is, especially for growth investing also these days, right?
Yeah.
People just look at the internet and see, this stock is very popular right now. It has gone up 20% in the last 3 months. So they kind of extrapolate and think, okay, next 3 months, it also got another 20%. So of course, some people, they really invest in this stock because they have the conviction. But at the same time, there's also a big group of people who don't know much about the stock. They only invest because other people are doing that, and other people are actually making a lot of money. So I think that's really a very common mistake when it comes to growth investing. Because personally, myself, when I speak to some of my community members or my students, right, last time they also do something like that. Just follow the crowd blindly. Herd mentality. And you think, oh, up 20% means after that it's going to up another 20% and 50% and so on. But sometimes it may not be sustainable, especially if the company is not fundamentally sound, right? Then at some point, it's going to come back crashing down.
Oh yeah, to add on, the herd mentality was even more obvious during the past few years is because of the crypto market also.
Crypto
I have
market.
a lot of friends, dabbling into NFTs and crypto.
Yes.
So they also just follow along and then buying and selling off, especially with the hype of the NFTs back then. So there were a lot of projects they really put in
a lot of
either
money.
A lot of time or a lot of money. So some of them did well, some of them obviously lost a lot. Yeah, so that is definitely, I think it still happens. Whenever there's a new hype, then people will just follow along, go with the noise.
I think at the end of the day, it's because we are all humans. Right?
Yeah.
So we have emotions.
Jay bought the NFT for 1 million plus.
Yeah,
then
I
still
think I
the
recall
news.
seeing that
Yeah.
too. In fact, a lot of artists
all
actually did
humans.
that.
Then after he bought, then straight away the crypto market come down.
Yeah, so probably we have to manage our emotions, but although it can also be rather difficult because we have emotions, right? We are human beings. Yeah. Any other questions that Choon Kai you have?
If we lack of time, we just want to really do a 5-10 minutes research or maybe a research program on the trade, will there be specific metrics that I should look into for small cap stocks that quickly let us understand the fundamentals?
I would say you need definitely more time. If it's 5 to 10 minutes, I will usually just focus on two things. Whether there's revenue profit growth, so recent results, is it showing upward momentum? So to, you come down to the bottom already, is there growth to pull you back up again? The second thing is like what I mentioned, insider trades. Whether there's any share buybacks or CEO buying back the shares. So these two things are the ones that really will catch my attention, and then I will continue and do more research. Whether they are fundamentally sound, what is their story, like in the past, cost overruns, will I still expect this to happen and things like that. Yeah. Maybe I share another example is SATS Group, SATS. So as we all recall, they did very poorly in terms of share price because of COVID. So COVID, then all the operations being impacted.
Yeah.
And the current CEO, went to acquire another WFS. With the rights issue and things like that. So the market didn't really like that move back then because he was like, I think in the public space or the forums and everyone was saying that, oh, you just came in and you spent so much to acquire an even bigger competitor, right? What are you doing, that kind of thing. But so the share price came down, right? Quite a lot, from $4 to $2. And then I did some homework after they started to turn around a bit of profit. So the profit back then was very low, but from my point of view is that, they are really coming back up again. They are reporting profits. They are no longer loss making, and the share price is still down. So back then when I saw it was $2, around $2. Yeah. So that was when I did a lot more research. I really pour my attention into all the past results, and then I even went to the WFS website to see what their operations, where they are based in, and continuously there were a lot of press releases given by SETs on they are expanding in that, they are going into the food solutions, tie up with airlines and things like that. So from there I see that the other catalyst is that the tourism boom, which is the airlines, they are all like, my wife want me to keep traveling because we already missed out for 3 years, right, during the COVID period. So I see, okay, SIA already went up. SIA Engineering already went up, which is the stock that haven't go up yet. So back then, I think that trip also, because I went overseas, then that trip really also let me look at the food. Yeah, the food is from SIAS, right? SATS, right? So I really from there, then I taste the food. I also do some scatterbar and I ask my wife, food nice or not? The kind of thing, and I realized it's not about the food being nice or not. It's like when you're on the airplane, you have nothing to do, you want something to eat. So I think that's a very recurring kind of
essential part of air travel.
Of air travel. So then I invested my money into SATS.
Okay.
So they even supply food for cookhouses in the army.
Yeah, that one is a long-term story. That one I know. Like, I mean, I've been through army. I always see them serve the food.
So there's like a consistent.
That is the consistent business. But then going forward, right? What can be used
growth
to
driver?
The growth drivers, correct. So I see that they are expanding in so many airports, doing the ground handling, as well as they also release a documentary in Netflix. I watched the documentary. I mean, if readers are keen, they can watch a documentary for SES Group. Yeah.
As we wrap up this episode, right, Choon Kai, maybe you'd like to share any insights that you have gotten out from this conversation, or has this discussion actually changed your initial perspective in any way?
I did learn a lot. I feel like there's some very different perspectives. I feel that I had never really delved into small cap stocks like this deeply as compared to James here. So now it broadens my horizon about, I mean, I read the news, but I'm more on like the economic news or what's happening to the economics, so that I have to have an understanding, so I can talk with it to my friends, my clients. But to like really go into specifics, read the insider news, check really into the revenue, whether they start making profits into like this deeply. These are things I think I should start considering for my own investment portfolio also.
Thank you.
He actually inspired me to look into small cap stocks.
Wow.
I think the risk appetite is still there, so
You
I feel like
reignite
I
his
should
interest.
More follow.
Need to start taking more risks again, maybe to build the portfolio even faster. Especially now I have the time frame to go into small cap stocks.
When you're still young. So as usual, James, could you share with us a final piece of advice for beginners who are looking to explore either growth value or small cap, but they're still feeling uncertain?
I think I get this question quite often, in the sense that beginner investors, sometimes I have army friends just Facebook message me, hey James, I know you are investing. Can you give me a few tips of stocks to buy? That is the wrong way to go about it. It's not to learn about what stocks to buy. First thing first, you must learn what is your plan, like what I shared just now. What is your objective? Is it to grow your portfolio? Is it to make a dividend income or things like that? Then from there on, you can look at the stocks that are in that space. Yeah, so I would still say that start off small, make some mistakes along the way, because you're bound to make mistakes. At least you can learn from it, not making too much losses. And one very good way to get started is maybe to go into ETFs or robo-advisors.
Okay.
Yeah, so from there, then maybe you will be more vested, and then you will spend more time looking at the counters inside the ETFs or the funds or the unit trust. And then maybe, when you get more and more comfortable, when you get more extra spare cash and you want to try it out on your own, then you can go and do more research on stocks. I use SGX tool, right? The SGX stock screener. Screen for some that you feel, okay, they has fulfilled my criteria. Maybe I'll just put in a bit of money into them.
Okay.
And then slowly build your own investment portfolio from there.
So start small and then have a plan at the start first before you dive into it. Yeah, and I think what's very important also, you have to give a reasonable period of time to observe the performance of the portfolio, right?
Correct.
There are some investors, they invest maybe 3 months, 6 months, then they think, oh, this stock is not making me money. Okay, it's the wrong stocks to invest in. Move on to another category.
Yeah.
But sometimes, for example, if you have market crash could take 6 months, 1 year, 2 years or more to recover, right? So we need to give a reasonable period of time to do the assessment of the performance of our portfolio as well, especially for beginners who are new to this, right?
I think I have one more thing to add is about finding your edge in the market. For example, Choon Kai, when you mentioned about your bond funds, you seem extra passionate about it, like because you already done all the research, right?
Yeah.
Yes. So this is his expertise. So if I were to so-called advise you is, I think you should carry on your own strategy, because that is what makes you the most risk to reward ratio lah, in terms of finding your own cup of tea or like your own edge. And for me, I think a lot of people wouldn't like my style to invest in small cap stocks.
Okay.
But that is how I find my edge. I really deep dive, right, look at the different aspects. So it's not it's not for everyone. So like, for example, people may not like small cap stocks in the first place. It's too small, too volatile. They prefer blue chip stocks like banks. A lot of people go for banks, REITs, but that is their cup of tea. So I think most importantly is also to find your edge, what you are good at, and across like maybe a good time horizon, like 3, 5, even 10 years, you ask yourself whether you have performed well in that particular space before you I have made good returns for small cap stocks, so I'm going to carry on and do this.
Yeah, I think that's a good point. Yeah, finding your edge, right? And so the strategy that you have to manage the different kinds of stocks, right, may be different. So you may have found an appropriate strategy for yours to manage the small cap. Then for you also have something else that you're actually looking at. Yeah, so really it's finding your edge. And in investing, there is it's
so
not
many
something
ways,
like
right,
where
to
it's
make
a
money.
science, or you have just one fixed answer, right?
Correct.
Yeah, so you have different styles, different strategies, and so on. So finding what fits you the most and can deliver the results for you, I think that's really important.
I think maybe I can share a bit on what I did with the ETF.
Okay.
Was that when I bought, it was actually at a higher price, but maybe I really had the risk appetite. I really didn't think that this market will do well. So when it dropped to about 50 cents, instead of like cutting loss, I doubled down on it. So it really depends. The object, as James said, the objective needs to be very clear. You really needs to know what you want out of it. So my target was at this certain price, maybe like $1 that I want to exit. So when it dropped to 50 cents, obviously my response was to double down, because I know that. So this averages out my cost to about 60 cents. So right now at 70, 80 cents, if I want to take profit, I can probably take some of it and maybe reallocate into something else. Or maybe I can just hold and wait for the desired price target I wanted. So it comes down to the objective. Whether you want to double it down. I mean, you really need to have the risk appetite to even want to double down for sure.
Yeah.
So as I said, some really like bank stocks, some like REITs, some like ETFs. It really depends on how much risk can you take also.
And I believe, when you say you double down on something, let's say, it's cheaper, right? So some people, they think it's higher risk lah. But for me, if it's a good company, right, for instance, then to me, that is not higher risk, that is actually lower risk. Because I'm buying a good thing and I'm buying at a good price. So I think the perspective of risk also differs from investor to investor, right? So so that's the style that you have to figure out how to manage your risk together with the returns. Yeah. So thank you very much, right, James and Choon Kai,
Thank you,
for
Hazel.
these insights and experiences that you have
Thank you,
in your
Choon Kai.
investing journey, and talking about today's topic on growth versus value, feed the small cap stocks. Right. And I hope that today's discussion has helped you to gain a better understanding on how to find that real winner for your portfolio, because everyone's winner might be different. Until next time, keep your FOMO in check, stay informed, and happy investing. See you again in the next episode of the FOMO Fix. If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.